scrying for profits, channeling stock market revelations, for uncertain times. Warren Buffett, the Oracle of Omaha, one of the most successful investors in the world, called The Intelligent Investor, by far the best book on investing ever written. Its author, Benjamin Graham, known as the father of value investing, was Buffett's one-time college professor, mentor and early employer. The basic ideas of investing are to look at stocks as businesses, use the market's fluctuations to your advantage, and seek a margin of safety. According to Graham, value investing is then buying stock trading at a discount to its intrinsic value. Graham's valuation methods will be used later for comparison. For now, we will reveal our own method for determining the value of a given stock. To differentiate our approach from Graham and others, we will replace the term intrinsic value with instantaneous value, as our aim is to value stock at that instant in time where we would wish to buy or sell it. We maintain that the instantaneous value of a stock must be at least equal to its book value per share, where the book value is the company's total assets less its long-term liabilities. The book value per share is then the book value divided by the number of outstanding common shares. It also serves as an indicator of the amount of money per share that shareholders would theoretically receive if a company was liquidated. A company must additionally be worth any earnings that it generates during the course of its business activities. A company's earnings are its after-tax net income, which is also known as its profits or its bottom line. Earnings are perhaps the most important and most closely studied number in a company's financial statements and the main determinant of a company's share price. Clearly, or at least in all practicality, a company is often valued at more than just book value and earnings, and a premium, or time factor, is required to accommodate the present desirability of a stock in the expectation of future growth. The determination of the time factor introduces the greatest uncertainty and variability in the calculation of the instantaneous value of a stock. Mathematically, the time factor is also equal to the payback period, or length of time that it will take the current earnings to recover the cost of the investment at the instantaneous value. Shorter paybacks, and therefore lower valuations, make for more attractive investments. We also maintain that the time factor must be equal to a constant, multiplied by the growth expected over the payback period. So how do we uncover the value of the constant? First, we will need to look at some financial data, which we can readily obtain from Yahoo Finance. In Google, click the Yahoo Finance link. In the Yahoo Finance search bar, type NVIDIA as an example. Click on the NVIDIA option. On the summary page, click the Analysis tab. Scroll all the way down to Growth Estimates. Second from bottom is the per annum, earnings per share, growth projection for the next 5 years, which we shall use as our payback period. The original time factor expression, which is equal to a constant multiplied by the latest future earnings growth estimates, is now set to 5. To derive the constant, and for it to be as widely applicable as possible, or universal, we'll test it using the growth rate of the broader economy, or long-term inflation-adjusted GDP. For the US this value is approximately 2%, which is also true for most sufficiently advanced economic nations. Simply then, the instantaneous universal constant is equal to the payback period, divided by long-term inflation-adjusted GDP, or 2.5. So, our time factor is now 2.5 multiplied by the latest future earnings growth estimates, or 2.5g, and the general formula for instantaneous value becomes, book value plus 2.5g multiplied by earnings. While we have now developed the expression for instantaneous value, which relies on 3 key financial variables, known to us as the Holy Trinity, we will need to test it for accuracy and applicability to the stock market. In the 1973 edition of The Intelligent Investor, Benjamin Graham described a simplified equation intended to produce stock valuations that were fairly close to those resulting from more refined mathematical models. The equation states that the value of a stock could, under favorable conditions, rise, within a given reference period, to twice its annual growth, plus 8.5, at the time the average price-to-earnings ratio of a zero-growth company, multiplied by its most recent annual earnings per share. Sometimes, the formula is referred to as the intrinsic value of a stock. Graham also developed another equation, called the Graham number, which is believed to represent the maximum price that a defensive investor should pay for a given stock. The equation states that a stock would potentially represent good value if the price was below the square root of 15 times the latest annual earnings per share multiplied by 1.5 times the book value. Typically in our experience, the Graham number for a stock is significantly lower than the Graham formula. We could say, although it would be a hugely simplistic view, that investing in a stock at a value below the Graham number could provide an adequate margin of safety to its intrinsic value, given by the formula. As the instantaneous value uses the same three variables as Graham, comparing the two methods appears appropriate. The three variables for a given stock can be readily obtained from Yahoo Finance. Using NVIDIA, on the Summary tab you will find the trailing 12 months earnings per share of $3.73. Now go to the Statistics tab and scroll down to the Balance Sheet, where you will find the most recent quarter, book value per share of $9.58. Finally, go to the Analysis tab, scroll down to second from bottom, where you will find the Analyst Consensus, year-on-year earnings per share growth rate, expected for the next 5 years, of 22.80%. So, let's compare valuations for NVIDIA. We want to compare what we call our terminal instantaneous value with the Graham number, and what we call the growth instantaneous value with the Graham formula. Taking the Graham number first, we can populate the spreadsheet with the square root of 15 times earnings times 1.5 times book value. Then we populate the terminal value with book value plus 2.5 times 2%, which is the growth rate expected for a business growing no faster than the broader economy, times earnings. The growth value with book value plus 2.5 times the annual consensus growth rate for the next 5 years multiplied by earnings. Finally, the Graham formula is earnings times 8.5 plus twice the consensus growth value. Now we can populate the spreadsheet with the holy trinity of book value, which is equal to $9.58, earnings of $3.73 and annual growth expectations over the next 5 years of 22.80%. For good measure we can add the current share price of $136.47. As you can see, we have very good agreement between the terminal value and the Graham number and nearly as good agreement again between the growth value and the formula. Also, the current share price lies comfortably between the two extremes. If you have followed our previous revelations, you will know that we focus on 56 components of the S&P 500, which we know as fragments, selected for their market capitalization, liquidity, and availability to be traded in extended hours. So what does the valuation comparison reveal for the 56? Well, for most stocks there is good agreement between the instantaneous value and the Graham expressions. In fact, the terminal value has a 96% correlation with the Graham number, and the growth value has a 98% correlation with the Graham formula. By accident or design, the Graham number, which is the maximum price that a defensive investor would pay for a given stock, is priced at its terminal value. i.e., when a stock is growing at a rate no faster than the broader economy. Note, some gaps appear in the valuations as the calculations only work for asset-rich, profitable, growth companies. In other words, companies with positive book value, earnings, and growth. For companies with negative values, other valuation methods must be employed. If we go back to our general formula, basically, if a company has no growth, then its terminal instantaneous value should be no more than the book value plus earnings. If there are neither earnings nor growth, then the terminal value should be no more than the book value. If there is neither book value, earnings nor growth, then a company probably isn't worth very much. It is reasonably common for high-growth stocks to have neither positive book value nor earnings, but command spectacular stock prices. Nevertheless, we would look to purchase a high-growth stock at no more than 2.5 times the terminal growth rate, or 5 times earnings if it has no book value, and book value plus $5 if it has no earnings. If it has neither, then the terminal instantaneous value would be no more than $5. Similarly, our expectations for price appreciation would be based on the growth instantaneous value. At some point in the 5 years following investment, we would expect to see a price of 2.5 times its growth multiplied by its earnings if it has no book value, and book value plus 2.5 times the growth if it has no earnings. For the most likely scenario of neither, profit taking at 2.5 times its growth would be implied. We can modify our spreadsheet further by utilizing these rules to provide valuations for stocks that do not have positive book value, earnings, or earnings growth. This rather complicated expression basically applies the general formula for instantaneous value, but uses a figure of 0 for book value, if the book value is negative. 2% for earnings growth, if growth is less than 2%, and $1 for earnings, where earnings per share is less than $1. Apply to all 56 fragments to obtain a valuation for each stock. Remember, the Graham number is the maximum price that a defensive investor would pay for a given stock, and because of its strong correlation, we hold this to be also true of the terminal value. So, if the current share price is below the terminal value, we would rate it a buy. Likewise, if at any instantaneous point in the future the current share price was above the growth value, we would rate it a sell. Currently, we have 11 buy ratings, where we feel the stock is undervalued, and 17 at sell, where we feel the stock is overpriced. A further 28 have a hold rating, where we would not buy the stock if we did not own it, nor sell it if we did. In summary, we hold that the terminal instantaneous value, which has been shown to be approximately equal to the Graham number, may be a useful indicator of value in a stock. While it may present a potentially good buying opportunity, its availability would be expected only to occur in a strong bear market. Likewise, we hold that the growth instantaneous value, which has been shown to be approximately equal to the Graham formula, may be a useful indicator of irrational exuberance in a stock. While it may present a potentially good profit-taking opportunity, its availability may only occur in a strong bull market. Remember, it may be a great time to invest but a terrible time to buy. Forthcoming revelations may tell. Until then.
Fly, you fools!